Hey, I'm Ben from Modern Graham, and today we are going to do a Modern Graham valuation of Essent Group Limited. So let's get started. We have Essent Group Limited. The ticker is ESNT. The current price is $39.86. This is a financial services company in the insurance industry. And here we have the items from the balance sheet that I find most important. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. And all of these figures will come in play in the valuation. Over here, we have a chart showing the earnings per share and the dividends per share. You can see earnings per share. This is a relatively young company. It has grown its earnings. It had a dip in 19, but other than that, it has been growing every year, and it started paying a dividend in 2018. Here it shows. And let's look at the detail. So earnings, you can see earnings per share diluted. That is the raw number. And then earnings per share MG, that is a normalized or a weighted average of earnings, looking at the last 5 years and putting the most weight on the current year and the least weight on 5 years ago. That helps balance out the business cycle so that we can see actual trends in the earnings over the long term. And you can see that has been rising as we go. Over here, we have dividends. Like I said, they have paid dividends for now 3 years. Here, it shows the data starting in 2019. So that is what we should look at. Now, over here, the dividend yield is only 1.5%, but it has grown for 2 straight years. Two years over the 3 years there. And dividend payout ratio is between 10 and 20%. So they have a lot of room to continue to grow that dividend. Stage 1 is to determine if the company is suitable for the defensive investor or the enterprising investor. And remember, the defensive investor is one who is not willing to do extensive research into individual companies, so they have a very stringent set of requirements. First, market cap has to be over $2 billion. It passes that. Current ratio has to be over 2. It passes that with 8.75. Earnings stability, it has to have earnings stability for 10 years. Here it has 9 years, and that is only because at the beginning, while it was still getting started, it had negative earnings. It has had positive earnings since then. Dividend, it's supposed to pay for 10 straight years. It has only done it for 3 straight years, so it fails that. Earnings growth, earnings have grown more than a third in the last 10 years. And PEMG, the price to earnings with that weighted average earnings, that is 6.55. That is below the defensive investor's requirement of 20, so we pass that. Price to book ratio is 2.5, or it has to be under 2.5. Here it is 1.0, so we pass that as well. So the total score is 5 here, if you've been keeping count. But one thing to note is that in a year, it will be SIPs. Assuming that everything else stays the same, it will be suitable for the defensive investor as well. Enterprising investor. So the enterprising investor is willing to do more research into an individual company to make sure that it is a good investment. And so the requirements are not quite as stringent here. Current ratio only has to be over 1.5, but it passes that. Then it has a debt to net current assets requirement. Here that is 0. It has 0 total debt. So that passes. Positive earnings per share for 5 straight years. It passes that. Currently pays a dividend, and it has grown its earnings. So it has a perfect score for the enterprising investor. If you've been enjoying this valuation, please take a moment to like the video, subscribe to the channel, and download the free valuation calculator in the comments below so that you can do valuations on your own using the Modern Graham method. Stage 2 is to determine the intrinsic value. And remember, the intrinsic value is different from the price. The price is what the market is willing to pay right now for a company. The value is what it's worth. And to get that value, we take Benjamin Graham's formula from the Intelligent Investor, which is value equals earnings per share times 8.5 plus 2 times the growth rate. I've modernized that by using that weighted average of earnings. So we have 2 variables to calculate. We have the earnings to calculate, and we have the growth rate to calculate. So let's go get to that. Earnings, like I said, we take the weighted average of the last 5 years. We get 6.08. We put that over here, and we take the same figure from 5 years ago, 3.43. We calculate the total growth between those two is 77%. Divide that by 5, and you get an average growth of 15.42% per year. Now, here's where we have a safety margin because growth is such a key variable in this formula. You don't want to overestimate the growth. It's important to have a safety margin there so that you are having a more accurate value figure. And so here we have a growth estimate of 11.56%. Let's plug those figures into the value formula, and we get a value of 192.34. With this handy chart, you can see that is much more than the price. So that is one thing to keep in mind, that it appears to be undervalued based on this. Let's look at a few other ways of thinking about this. Net current asset value, which should be a floor to your value, is 32.24. It is above that floor, but not by much, which is a very interesting thing to note there. Most companies have a negative net current asset value. Here, modern gram value based on 3% growth is $88. So if you assume the company will grow in perpetuity at 3% every year, then the value would be $88. If you assume the company will not grow at all in perpetuity, then the value is $51. And if you put price in for value and solve for growth, you can see that the market is implying that the market thinks this company will shrink by 1% in perpetuity. If you think that growth is higher than any of these figures, either -1%, 0%, or 3%, then you are going to find that the company is undervalued. It's another way of looking at this formula. Over here, you can see that the current price is 39.80. We're sitting at 20.72% of intrinsic value right now. And so modern gram opinion is that it is undervalued in this system. Moving on to the modern gram grade, this takes into account other factors as well, so that you can also get a grade to more easily compare to other companies across industries. Here we get 1.5 points for investor suitability because it is suitable for the enterprising investor. We get 1 point because it is trading undervalued. We get 1 point for being under its gram number, 0 for being a long-term dividend growth, 0.5 point for having a dividend yield above 2%, 0.5 point for trading below its industry average PEMG, and let me pause just a moment. Okay, I noticed a mistake in the calculation there. So we don't get any points for trading below the net current asset value because we are not trading below the net current asset value, for a total score of 4.5, which gives this company an A- grade. Stage 3, further research. If you've gotten to this point where you've decided it's suitable for your investment type, for your investor type, and you believe that it is undervalued, which is what we kind of came to the conclusion of, then it is time for you to do further research to determine if this company is suitable for your individual portfolio. You have to do this research because only you can decide if it is suitable for your investing goals and your diversification and stuff like that. But here are some things to help you with that. First is the net current asset value formula. Remember, this is a floor. This is the amount that if the company took all of its cash and paid off all of its liabilities, this is what would be left over to pay out to shareholders in cash today. And that is just barely less than what the value or the price of the company is. So that is very interesting to note, that you are essentially paying $32 to get the assets of the company, and then $7.50 to get the potential earnings growth from those assets. That is very interesting here. Gram number formula. The gram number is a number that was derived from the defensive investor requirements, and people often use it as another way of looking at those requirements to have a number to determine if a company is worthwhile. And here the gram number is 83.70, which is significantly higher than the price as well. That could be another indicator that it is undervalued. PEMG, the price to earnings ratio is 6.55. Current ratio, as we've talked about, is 8.75. PB ratio, price to book, is 1. Currently, the dividend yield is 2.15%, and it has had 4 years of consecutive dividend growth. Moving on to stage 4 in the analysis, let's get to a chart here. This is the daily chart, and you can see different things here. It is a little bit cluttered, I will admit, but you can see that we have been moving up and down, and what we've got here is various different candles. Right now we're moving up, and it's important at this stage, I should mention, that you don't want to rely on technical analysis and chart analysis and looking at the charts and stuff like that in order to determine if a company is a good price. What you want to do is use it to figure out if it's a good entry point. You know from the earlier analysis that the company appears to be undervalued, but that doesn't mean that the market is currently about to go up on it. What you want to do then is kind of figure it out where will be a good time to come in. And right now, it looks like the company is on the way down. So we can see here a doji star here, a DS. That means that there was indecision here. It was on the rise. It hit some indecision. It looks like it hit a lot of resistance at about the $40 mark. And then it appears to be coming back down. It had another doji candle here, but it is coming down. And then you can also see that here, this is the relative strength index. The momentum, it has stalled a little bit, and it's coming back down in the middle here. Let's switch to the weekly view, and you can see that a little bit more as well. On the weekly view, we might be coming up, but right now we might be on our way down. So it might be hitting a limit and coming back down a little bit. I would really pay attention over the next couple weeks to see what happens. And it might come down, and then you could see a little bit of movement like this where it comes down and then comes back up, or it could keep going down. But I think it is appearing to be at a turnaround point where it will come down a little bit, and you would want to watch that. But anyway, that's it for this valuation. Be sure to click on the one on the screen. It will take you to another one that I think you will enjoy. Thanks for watching, and I will catch you next time.